Hello, everyone, and welcome back to the Conrad Challenge webinar series. My name is Joey Segura, Innovation Challenge and Programs Manager here at Space Center Houston. Today's session is Funding and Futures, Finance, a conversation designed to help you think about your innovation not just as an idea, but as a venture. In the Conrad Challenge, strong ideas are paired with smart strategy, and that includes understanding how your project will be funded, built, and sustained over time. By the end of this webinar, you'll be able to identify and estimate the key costs behind your innovation, understand what judges look for when reviewing your financial section, think strategically about how to fund and sustain your idea over time, apply real-world financial thinking, the kind used by economists and industry leaders, to your own student project. Now, here's a rundown of how we are going to spend our time together today. Right now, we are going through our welcome and housekeeping. We're going to have a guest expert discussion with Dr. Andrew Beck and Sahidi Dasari. We're going to have a Q&A session, and then we're going to have some closing and next steps. Now, without further ado, we are joined today by two incredible guests. First, Dr. Andrew Beck, Manager of Economic Analysis at Equinor, where he evaluates and guides major energy and innovation investments. Dr. Beck brings years of experience in financial modeling, risk assessment, and strategic decision-making for complex projects. We want to welcome Dr. Beck from our challenge sponsor, Equinor. And then joining him is Sahidi Dasari, a member of the Conrad Alumni Leadership Council and former finalist who experienced firsthand what it means to turn an idea into a viable innovation. Now, on to our first segment of the day. Dr. Beck, before we dive into specific questions, where we're going to have a nice discussion with Sahidi and yourself, we learned through your background that you'd like to start grounding us in some financial fundamentals. So you're going to share with some financial fundamentals. I got a chance to talk to you about these. These are incredible foundations for not just any team in the Conrad Challenge, but also any student that's wanting to start into a venture. And this is going to enable students to learn some finance, the way real companies and investors and the way they think about value and risk. So, Dr. Beck, I'm going to go ahead and turn the mic over to you so you can share your wisdom when it comes to the financial world.
Thank you kindly. Yeah, thanks for having me. Appreciate you. And yeah, I think about basketball, I'm going to start with fundamentals. I think about reading, I need to start with fundamentals. I think about financial literacy, I need to start with fundamentals. And so I've worked in the venture space. I've evaluated hundreds of projects. I've worked in the BD space, and it always comes down to some key concepts. And that's where I think wanted to start today. So we can start simple. Money today is worth more than money tomorrow. Foundational idea. And I have 4 deals on the screen. So we can look at these and think, would we take these deals? Deal 1, I pay $100 today. I get $100 back next year. And probably not. Deal 2, I pay $100 today. I get $110 back in a year. Yeah, maybe I'd take that. Think about it. Deal 3, I pay $100 today. I get that $110 back in 2030. Probably not. Deal 4, pay $100 today. I get $150 back in 2030. Yeah, maybe. So we can think about these, but this is vibes. We need to go beyond that. We need to be scientific, and we need to say, how do we evaluate these business propositions objectively when we look at money flows over time? When we think about ventures, you're putting money down now up front with the hopes of getting money back later, and you need to understand how someone like me is going to look at that and evaluate that cash flow over time. So if we keep going, let's look at how I would look at this cash flow over time. And we'll start with these simple deals, deal 1 and deal 2. And really the idea is discount rates, the idea of discounting money that I get in the future back to today's value. So let's say I can earn 5% on general investments, CDs or bonds or whatever. Money today, I can earn 5% on that regularly over time. So if I look at that $100 in 2026, Well, I need to go back in time and say, how much would that be worth today if I could invest something today? And so 1.05 times that amount would give me 100. Simple division. I can see $100 in 2026 is worth $95 today, and I should not make this deal. Conversely, I go to deal 2 and I discount that 110 in 2026. I end up with $105 today, and I can see why I would want to make this deal. So with this idea of discounting money can help. It can help much more if we start looking at multiple, more complex deals. So let's go to the next deals. Same idea, but now we have more time. You could also imagine you have more flows, more downs, more ups, anything crazy you want to put in here. We can follow these same fundamental principles and evaluate any deal. So in this case, I have 5 years of time. So the alternate investment, I would need to put some money into an account, earn 5% compounding for 5 years, and see where that would be compared to my 110. So now when I look at the $110 in 2030, I need to say, okay, 1.05 to the 5th power times my starting money would be 110. 110 divided by that discount rate, I get $86. And I can see, yeah, the time kill of this deal. If it takes too long to get money back from a venture or from a project, it can kill the economics. On the other hand, it might mean I need more payout later. We can see in deal 4, same time amount, but now I'm getting $150 back in 2030. That discounts to 118, and this makes sense. So when we think of time value, the longer it takes for a payout, the bigger that payout's going to have to be for this to make sense. So if we kind of put this all together, this is the idea of net present value and also internal rate of return. So net present value can be tricky because it can be subjective. I have to know how my investments move over time. I have to pick a discount rate and I have to say, yeah, money to me can earn interest at 5%, but that can be different for everybody. If I'm looking at a big company, maybe that's 12%, 15%. If I'm looking at me personally, maybe I'm a conservative investor, maybe it's 2%. So that can vary. So then we also have the idea of an internal rate of return. So an internal rate of return is, let's look at this cash flow, and we can go back to deal 1, 2, 3, and 4. On the right, we have the same NPV at a 5%, but we also have the internal rate of return. And this is you're solving and you're saying what discount rate would make me break even. So on deal 1, I would need a 0% discount rate. Money in the future is the same as money today, and that's what would make me take deal 1. So no one's ever going to take deal 1. But if we look at more complicated deals, deal 2 I can see has an internal rate of return of 10%. Deal 3, 2%. Deal 4, 8%. So I don't know what an individual investor's IRR is, their internal rate of return, but now we can look at deals and compare them objectively. I can say, okay, deal 2 has a 10% return, deal 4 has an 8% return. I'd rather have deal 2. I'm having a higher rate of return and I get my money back quicker. So if I'm stacking up 5 projects and I can only fund 2 of them, I'm looking at IRRs, I'm looking at paybacks. These are critical. When I think of the BD space right now, you're looking at 12 to 15% are the returns I've seen kind of in the market and in the energy space right now. That can vary sector to sector, but in general, we want to see double-digit returns for a good investment. You'll hear companies talking about this all the time. Investment bankers are talking about this. Stockbrokers are talking about this. What's your rate of return? What's your returns? It's this. We look at the cash flow and we find the IRR. And you can do this in Excel, the NPV and XNPV formulas, the IRR and XIRR formulas, they're your best friends, and you should look at cash flows over time. So that's one piece, money over time. The other piece we're going to look at when we're looking at investments is risk. And risk tolerance can also depend on wealth. So let's look at this first deal on the left. The circle's an uncertainty. We're flipping a weighted coin. 70% chance I get $10, 30% I get nothing. Would I pay $5 for this deal? But we can calculate the expected value. 70% times the first outcome, $10, plus 30% times the second outcome, 0, gives me 7. So if I pay $5 for something that's worth 7, yeah, that could make sense. Maybe I should go do this deal. But on the other hand, let's look at the same thing scaled up. I just added a bunch of zeros, same concept. Would you pay $5 million for the deal on the right? Well, the expected value says yes, but me, Andrew Beck, I don't have $5 million. I can't pay this deal. So even though it's the same deal in principle, when things get bigger, it gets riskier. So if you're thinking about your venture, the more money you're asking for, well, then you're getting people's pulses rising and people are saying, wait, can I actually afford this? Now to fund your project, I can't fund these other 6. And so when you're thinking about the size of your project, it can make a big difference in terms of how people are willing to fund you. One other thing, when we're thinking about ventures, it's often about replicability and accuracy of probability. So this is a very different type of deal. Here, in this deal on the left, 10% chance of making $100, 90% chance of getting nothing. Big chance I lose money, but if I win, I get a big payout. Would you pay $5 for this deal? Well, the expected value, 10% times 100 plus 90% times 0, is still $10, positive expected value, better than the deal on the last slide. But you look at this and you're like, but I'm probably going to lose money. So what do we do in the venture space? What do we do in the business space? Well, I don't want one of these deals. I want 100. But I pay $500 for 100 of these deals. Because if I can take this weighted coin and flip it 100 times, now there's less chance involved. If I'm good at evaluating probability, or alternatively, if I trust the probability that you're telling me from a venture, well, I know if I flip a coin 100 times, I'm probably not going to get 10 wins, but maybe I'll get 8. Maybe I'll get 12. I'm going to get something closer to what I'm expecting. Now I have a bundle of deals and I'm much more likely to get the average value. So when I'm looking at a venture, I say I want to get a bunch of good looking deals, put them together. That's worth much more than one deal by itself. And so that's really what we're looking for. If we put this all together, I did not make this up, but this is a thing I've seen a bunch of times, so I replicated it here. Investment quadrants. If we look at the x-axis on the bottom, the value is successful, low value on the left, higher value on the right. On the y-axis, we have the probability of success, low probability on the left, high probability on the right. These are different types of businesses. In the top left, bread and butter, small projects, operational improvements, little things around the edges, better software. I also think of the insurance space where every time I give out an insurance policy, I expect to win on that, but win a tiny amount every time. So it's small projects I expect to win. Pearls, the top right, you can't just buy these, right? These are things that are going to make money. I can launch a Pokemon game. I'm going to sell 10 million copies. I can sell a new iPhone. Great, I just sold 100 million iPhones, right? You can't buy these, but you're looking for these. So in ventures, we're in the bottom right, these oysters. We're looking for pearls. We're looking for the next really great type of investment, but we know we're not going to hit every time. And so we're really looking for those two things. How likely is this to succeed? And what's the payout? What do I think I'm going to get if I win? And so it's really those two factors are all of it, because at all costs, we're trying to avoid that bottom left situation, the white elephants, where I have a low probability of success. And if I succeed, it might not even mean anything. We never want to put money in projects like this. So we're always looking for these oysters, these things like, oh, wow, that sounds like a pretty good idea. Hey, I actually think you have a chance here. Hey, I see the market for this. That's the kind of deals we're looking for over here, these oysters. So it's all going to come back to value, IRRs, NPVs, and probabilities. How likely do we think it's going to be? So these are the fundamentals. Anytime I'm looking at a deal, I'm always looking for things like this. I'm always challenging things based on these ideas. And I expect that's what judges will be looking for here. But that's my spiel. That's kind of what I wanted to start with. And then I think, Joe, we can kick it back to you and start thinking about more Conrad-specific questions to kind of help this group here.
Wow. Well, hey, Dr. Beck, thank you so much for sharing your knowledge with our students. To our audience, to the viewers, I hope you understand just how much information you were able to gain from a professional in the financial industry for a major energy company and what they're looking for in terms of investments and ventures and things like that. I think the biggest key takeaways we can have here is good business cases, good ventures will have a balance of that value, risk, and feasibility, which is all, like Dr. Beck said, all which tie directly into how teams in the Conrad Challenge or just even startup companies, as you all go into the world of entrepreneurship, should approach their companies, should approach their ventures. This is a fantastic foundation. I specifically love the that last example with the quadrant on there. And it really just shows that finance just isn't just solely math. It's a way of thinking about decisions, trade-offs, and opportunity. And the teams can take some of those foundations and the Q&A that we're about to go in with Dr. Beck and Sahidi. They can really strengthen that financial aspect of their Conrad Challenge innovation portfolio. So, with that being said, we're going to switch things up. And now that we've set the stage with the fundamentals by Dr. Beck, let's connect these fundamentals to the Conrad Challenge. Dr. Beck, Sahidi, I'd like to walk through just a few areas that really challenge our student teams and hear how both of you would approach them with from your perspectives, Dr. Beck as a professional and Sahidi as a Conrad Challenge alumni and now a student in higher academic. All right, we're going to start with you, Dr. Beck. Dr. Beck, you mentioned earlier that realistic cost estimation starts with mapping out key categories, people, materials, and operations. How should students approach that with limited data or experience?
Yeah, when I think of cost estimation, I think the first thing to start with is honestly pictures, diagrams. If I go get audited by the IRS and they're challenging costs, they ask for pictures, they ask for schematics. They say, why was your solar panel twice as expensive? Show me the picture that proves that it's better. The picture really helps you map out what are you actually doing. So you could have pictures of products, of processes, but then you can look at those things. What are all the components in here? What's every single thing I've drawn? And we need a cost for that. I need to get that from somewhere to here and manufacture it and then get that product out. So I think diagrams are a first place to start. Then I think of categories. So I always try to think of what are the different categories that are showing up here. Physical assets. So, what are my materials? Do I need machine rentals or purchases? How am I putting things together? Or do I need anything custom? Do I need specialized tools? I think of non-physical assets, computer software, transportation, shipping, tariffs. What are things I'm going to have to pay to move things around or to think about things? I think of people costs. So your employees, contractor costs, specialized labor. Do I need to get an expert to build something for me or design something for me or weld something for me? That has a cost. Then I think of commercial things like access fees or how am I physically in a space? And then if I'm checking something, it's always triangulation. So the last 3 years, we have AI coming out. I don't love AI personally, but it's an incredible tool if it's used in something like this, as triangulation it's really valuable. So I can try to look at what do other similar products cost? What do similar processes cost? I can use AI and I can use different AIs to triangulate and say, okay, what do I think it's going to cost to do this or to build this? Or what's it going to cost to build one? What's it going to cost to build 1,000? What's it cost to scale things up? It's a tool that's there. And then it's sense checking with people, talking to people with diverse backgrounds and skill sets and saying, does this estimate make sense to you? What do you think I'm missing? Am I crazy? Like this is so expensive. Did I miss something? And the more different types of people you can talk to with the different backgrounds, they'll see something that you didn't see because they're attacking it from a different angle. So that's my takeaway there.
Thank you for sharing that. I really do appreciate that, especially the last part where you were talking about talking to people. That's something that's been a theme in our webinar series is, the best experience is getting to know, your market, your channels, your people. So I really do appreciate that. Zahidi, I'm going to turn this one over to you. In your experience in the Conrad Challenge, can you share how your team handled cost estimation during your project? As a student, as a high school student going through this, what tools, research, or creative methods helped you with this side of everything?
Yes, of course. So, I'd love to provide some more context on my own project. When I was a Conrad finalist in 2024, our project was a product called Biomet, and it was a physical scanner and software tool for developing countries to identify and track biometric markers on people, so they had identification. And so for Biomet, we knew from day one that affordability was something that was non-negotiable for us. So when we actually went into our cost estimation, we got really, really granular. And so what that meant is, like, as Dr. Beck was saying, we went into what are the three parts of our costs. We broke into like hardware, software, and as well as like estimates of like additional costs like services. And we itemized every single component down to also the manufacturing costs. And the research process was also really fascinating. So we were able to reach out to manufacturers like Exometry to get real quotes on how much these manufacturing costs would be in industry, so we could be very detailed and have data to back up our cost estimations. We also went online and used all the resources we could to get the actual hardware component like costs down, and we had different phases of how much our product would cost depending on the model. So our V0 was very different from V1, but we made sure that it was something that was practical and also like low cost, as we were saying. And some resources that were really, really helpful included just talking to producers in the same industry. So we were able to talk to people who had made hardware products that were similar and ask about where they were sourcing these things. And we were also able to go online, talk to go get on JLP. We were able to get on like KeyCAD and look at their parts as well. And so all of that was really good research. And a really creative method that we did use was building a more detailed expense distribution via pie chart to just show how much we were putting into R&D versus marketing versus maintenance and labor, which I think helped us show that we were also trying to make sure that our business was sustainable and the costs would add up to be something that was profitable in the end as well.
Wow. Thank you, Sahidi, for sharing that. And there's some really good nuggets in there for our Conrad competitors here. I think one of my favorite parts of your answers is that you based your figures on what was reality, going to actual sites, going to actual manufacturers and industry, and not just creating these numbers out of nowhere, but actually putting in the work on there, as well as going and even communicating and reaching out. And that's something that I would encourage all competitors to do is if you have questions that industry experts are going to have the answers for, send them an email, give them a call, right? That's something that's communicating with your community, communicating with people within your market. You'll never know what kind of answers you're going to get. We thankfully in the Conrad family, we have we've seen a lot of times that leaders right now are more than willing to support our future innovators. And that's what our innovators are going to be able to see this year. All right, so I want to move on to telling a story. One thing in the Conrad Challenge is our judges come from a wide spectrum of industries. Some of them are financial gurus like Dr. Beck. Some of them are technical experts that are going to be looking at these projects. And one thing that Dr. Beck was kind of mentioning in his answer prior is the use of images and graphs to almost tell a story, and being able to take these images and base them into reality. So Dr. Beck, you come into this world with financial prowess. You come in with in the energy industry. You have expertise in that realm, but we might have judges that might not be those technical experts, which means our competitors are going to have to be good storytellers. What makes a financial story engaging to these decision makers like judges or VCs?
Yeah, when I think about financial storytelling, it's not that different from any type of storytelling. I actually used to be a performing artist. I used to play on trash cans and play the drums around the city of Boston, around baseball games and stuff.
Awesome.
And anytime we had a show, you start with a hit and you end with a hit. And so what are your hits? It might not be the business case. So even if I'm going as a financial person and presenting a business case, I'm going to start with the story. Why are we here? What's the problem we're trying to solve? What's your solution? Why is your solution awesome and exciting? I want to know, you got to start with your elevator pitch and hook people. Then you can go into the details and start thinking, okay, here's why we're here. We ground there. Now what are the business fundamentals? Why is this going to make sense financially? What is it going to cost to make these components? When am I going to start selling things? When am I going to start making money? What does my scale up look like? Sahidi, you mentioned sustainability, incredible. What does it look like in the early phase when I'm growing? What does it look like when I have a sustainable business in the long term, right? It's telling that story of beginning to growth to sustainability is key, but then you need to bring it back to that meat, that hook. Again, why are you here? Why does this matter? What's the big takeaway? Your takeaway is probably not going to be your business case. Your takeaway is going to be, why does your product or your invention matter to the world? Why are people going to want it? Why does it matter? And that's really that storytelling. So you need those details in there, but that's the meat of your sandwich, but you need to have the other pieces in, or otherwise your story will flop. So I'll say that.
Yeah, I love the start with a hit, end with a hit. You have the hook and the close. I think that's a really good way to put it into perspective, especially when you're looking at telling it a story and hitting the emotional strings of judges or venture capitalists or investors. Now, Sahidi, in your experience in Conrad, how did you make your financial section understandable for judges who weren't experts in your field?
Yeah, so I think this is actually a great thing to highlight because most judges are not going to be experts in your field of technology or economic field either. So they're not going to know what the business is like in your industry. More specifically for my case, we were analyzing the biometric features of someone's face, and this was an issue. And this was a solution that was targeting a big issue. And what we did is storytelling was like a huge part of how we presented our solution because we presented the need really, really big and clear that over 1 billion people don't have access to digital IDs in the world. And so this prevents them from going and getting like the basic services like, registering in hospitals, getting phone plans, going and getting bank accounts. And so all these things are something we grouped as like our main first big hit. And then our strategy in the actual like finances of it all was connecting every, I guess, cost to our mission. So yes, we were trying to make a product that was feasible and viable and like gave us profit, but in the end we were doing this for people in need who needed, and for organizations that were going to deliver this to people in developing countries. So we always tied it back down. So for example, instead of just listing something on our cost estimate as like high like Raspberry Pi camera, $9, we instead would do something like the camera module, but also say this is a high resolution camera module to enable us with 98.93% accuracy. And I guess another thing we also really tried to do was use comparison tables. So our main selling point was that existing solutions in the business were not low cost. They were very costly. There was innovators in the area that were doing really great tech, but weren't looking at these people. And so we made comparison charts. We showed how our tech was more accurate for people that were marginalized, for women, for people of color. And then we also showed how our tech was lower cost. It was more affordable. It wasn't like the most advanced camera, but it was something that did the job and could be bought by governments in this area, local businesses in this area, and implemented. And so that kind of connection and story also immediately communicated what we were doing. And also going back to the graphics, a lot of the stuff was displayed in graphics. So we used pie charts, we used tables, we used charts. And I think that's a really, really clear way to like get your audience to see that you've done your research and also know that you're going to be successful.
Yeah, thank you. No, those are some really good pieces of advice to give to our students, and I really love the way that your team thought about that, and thank you for communicating that. All right, our next section here, I want to get into some financial forecasting and revenue modeling, market sizing. Now, Dr. Beck, many of our students who are hopping into this, the vast majority of our students, it's safe to say it's their first time diving this deep into anything financial, anything into revenue. What's some beginner advice on giving students when it comes to revenue modeling or determining market size or even just financial forecasting? These are the first times they might be diving into this. What are some beginning steps for these students to take so that they can effectively communicate, potential outcomes and those forecasts to the judges?
Yeah, absolutely. I think one of the ways to think about it is the starting can be a batch purchase. So if I'm thinking I need to buy a certain number of objects, so maybe it's 1,000 units. What is it going to cost to get 1,000 units? And we can try to get a sense of that. We can look at, the details, like Sahidi was talking about, detailed specs to get this. We can look at market comps for a similar product. What are people selling these things for? Does that make sense? We can look at how many units I would need to sell to break even on a batch. And that's one way to think about it in a digestible way. So the batch could be different depending on your product. So Sahidi, I don't know if maybe you started with like 100 as a batch. Maybe that would make sense for you. Or I think I was looking at, Indu's presentation in the first webinar, she was looking at smart shades for windows, right? So maybe your batch there is 10,000. It could be a different batch size, but thinking how many would I need to break even in terms of what is the market paying for these things? What are my costs? What's my difference there per product? When I think about a market size and the ultimate potential of a venture, I want to think about, well, what could this market be? Who is this market ultimately, and how much of this could I capture? So, I mean, Sahidi, I'll let you talk about your market. Seems fascinating. I'll go back to Indu's market from, that first seminar, because I thought that was interesting. So she was creating smart shades for people with skin cancer, right? To protect from UV light. Cool product. So who's her market? Well, you can think, who are people who have skin cancer? Who are people who have windows that they have access to and they own? And how many would be interested in these smart shades? And you can make estimates. You can go find some of that detailed information online about who you think your target audience would be. A much smaller percent of them are going to be interested in your product, and then you're going to end up with some kind of market share. Here you're thinking you're going to get in early and attack and get something early. Other people that come in replicate. So you're going to end up with an uncertain market share. But this can be a way to think long term. Who are the people I'm actually targeting? What does it look like? How big could this be? If you're thinking about batch sizing, okay, what's the first proof look like that I could sell a batch and break even, and then take this batch and scale up to something that looks like what I think my market share can be? And now you're looking at, starting small, getting medium, getting big, and what your potential could look like over time. So I'll leave it right there.
Yes, those are some great advice, especially just how, relevant it is to the real world. Not only can we, students utilize that here for Conrad, but they can also take that into anything in the future when it comes to creating those businesses. Tahiti, I was going to let you jump in. Can you give a little bit of background on, before you did Conrad, how much financial knowledge did you have when it comes to, creating a small business, and what steps did you take as a beginner in this sector, and then apply it into your Conrad Challenge project?
Yeah, of course. So, I mean, for some context, I had always been doing sort of like business, public speaking type stuff before Conrad, but this, I guess, like, opportunity was my first real look into going deep diving into how do I build a product from scratch to finish, and how do I analyze finances, market, all of that. And so it was a really cool learning experience. And when I dove into it, I realized that a lot of things I could take a lot of things I'd already had a lot of practice in, like customer analyzation, looking at graphs, looking at details, doing research, but I did learn a lot. So, for example, I think a huge thing that, like, Dr. Beck brought up is revenue modeling. So understanding that there's a difference between the market that exists and also the market that you can actually reach. For me, it was like very easy to do like a Google search and see a number like 31 billion, I guess, biometric identification market. But it was a different story for us to go in and realize, what is our product and who are we actually targeting? So we essentially built a tiered market model when we understood that, like, our total addressable market was way different from the total market that existed. And so we started targeting, I guess, specific people. We started targeting specific areas in the world. We started targeting specific institutions, and that really helped us reformat how we were pricing our product and how we were going to get profit out of it. We also looked into like TAM SAMSOM model. So, like, looking at your total addressable market, your serviceable, obtainable market. And this is something that's really great, not just for Conrad, but like when you're building a venture yourself and you're going to the real world. I think people want to see that you've done your research on how much are you actually going to be able to obtain in your first year, in your first 5 years, when you've commercialized your product. And also building a timeline with concrete numbers. So we did do like specific numbers. We built out how much we felt like we would be able to achieve in 6 months, in 12 months, in 3 years. And that those models for like ARR and revenue and like profit and like all of those stuff weren't random either. They were stuff we researched on how long it would take to get regulatory approval, establish manufacturing, and then build, the nonprofit partnerships and all of that. So I think the key advice I would give everyone in this section is to not just show like size really, but like show, I guess, the specific route you're taking through your entire market and with realistic milestones, more importantly.
Man, I think my favorite thing that you said here is, the market that exists versus the market you can reach, and grounding what you're doing in the reality that is obtainable and feasible for your team. I think there's a nugget there that I think some of these competitors can take from that, and that you're showing that you're not just going into theoretical realm or a what could be, but what is actually obtainable. Ladies and gentlemen that are watching, I hope you're taking some notes here, because Dr. Beck and Sahidi are providing us with some really great pieces of advice and fundamental knowledge that you can take to Conrad and beyond. Now, for this next question, I'm going to focus on you, Sahidi, because we've covered a lot of ground here, but I want to cover a different ground here. One of the biggest questions that we have that is in the financial realm, but not necessarily with that directly impacts their small business, but in a Conrad sense. Many of our teams at this phase, in the second phase, when they get into the innovation stage online or even the innovation summit, have to pay registration fees. That is a reality for the Conrad Challenge. In your experience as a Conrad competitor, you also had to pay these registration fees to go into Innovation Summit and as well as the innovation stage online. Can you give us a little bit on how you were able to get that registration fee? Like, what was your journey in there? Because we want to be able to give our competitors some baby steps or some knowledge or stepping stones on how to get that funding to pay for those registration fees.
Yes, of course. So yeah, there is a registration fee to get into Conrad, to compete and go through the entire process. And when we first saw it, it was something that we were like, okay, wow, how do we find funding and the resources to get through this? Because it wasn't necessarily something that we all realized we all had like the money lying down on the table for. And so it was a really cool learning experience, because we actually got a lot of experience in like funding and looking at our own resources when we were trying to fund our journey to enter Conrad. Something more specific is we reached out to investors and donors that we had worked with in past projects, from nonprofits to events that we've run to people we've hosted dinners for. And all of those connections came into handy when we reached out to them saying, hey, we're building a product. It's something that we're really passionate about. This is our mission. We are now entering this global challenge that can help us essentially patent and pitch our final product. And when we sent these emails out to a bunch of people we had already had connections with, and also people who'd be interested in our technology in the first place. And so when we did that, we ended up getting people coming back and saying yes, and we ended up raising enough money for all of us to get covered, not just on this phase, but like our next phase too, and travel and all of that. And so we also started a GoFundMe. So that's another thing that you could try doing, and marketing online on social media like LinkedIn or Instagram, and see how well that goes for you as well. But it's super possible.
So it sounded like you casted a pretty wide net, and you didn't just go ask one or two people, but you really started asking more and more people. One of the things you talked about that I really like is that you utilized past relationships to be able to, ask them for some financial support to help you into the Conrad Challenge, into the various levels. And I think that's something that our students can take away, is that, relationships are a big part of the entrepreneurship journey, the Conrad journey, the innovation journey as well. I imagine, and you can correct me if I'm wrong, but I imagine you had to go through a bunch of no's and very little yeses, but it's those yeses that are the most impactful. And you just got to keep on asking and have that resilient nature. So I do appreciate you sharing that. I hope the competitors here on the webinar today can take your example and maybe put it into practical use, because that's the cool thing about, that's the glass half full aspect of these registration fees, is it's your first actual practical experience in getting your idea funded. It's not just a theory at this point. It's you're putting it into play. All right. Now, for time's sake, I'm going to go on to our next section. Dr. Beck, I'm going to focus on you for this one here. In the world of investments, in the world of entrepreneurship, venture capitalists, there's the concept of trade-offs and iteration, how every project evolves through choices that we make. And this allows teams to communicate that they are making the best decisions possible for their business, their prototype, their company. What's the best way for these teams to show these trade-offs, to show these investors, these venture capitalists, that they are truly thinking through every scenario possible?
Me, the biggest one is transparency in the sense that you open up about those trade-offs and you say, hey, we had to make some trade-offs here. Sahidi, you just mentioned one. You said, I didn't go with the best camera. I went with the lowest cost option that got the job done because now I have this great product that I can sell. That's a decision that is a crucial early phase decision that can affect the entire project. And it's a really important decision to talk about. I think being open about what are your dilemmas and what are those choices you're making also can help bring a venture capitalist or an investor in because you're letting them know your mindset, but it's also a way for them to give you their thoughts. And so you can start building a relationship with that transparency. It also gives to trust, saying, hey, I looked at this option, this one, this one, this one. We looked at this realm of possibilities. We chose this for this reason. We know it's not the best over here. But again, opening up about those things is crucial because you're going to also have roadblocks as you're developing these products down the line. It's not going to go smoothly. So the fact that you've already evaluated all these options, something's going to go wrong later, but you learned something back here that you can then apply in the future. And so that idea that you're looking at this flexibility in what you can do is really important. It's people want to make sure that you're not married to this idea and saying it has to be this way. This is my product. This is my baby. It has to go like this. Because that's a red flag. Because like, no, something's going to go wrong and you're going to need to adapt in 3 years, right? So I think that's the biggest thing. What were the trade-offs you made? Why did you make your decision? And why did you ultimately land where you are? You're pretty smart people in this room. People want to hear that. They want to know what you're thinking and know your process. And that helps everything.
I love the term transparency is, a word that you use that I like is being open and honest and showing that these are the trade-offs. We could have gone this way. We went this way because of this reason. And I think that's a powerful piece of information because in this entrepreneurship world, in the Conrad world, as we've mentioned before, relationships are important. Transparency can build trust, and it builds, trust not only in the company as in the people, but it builds trust in the decision-making ability of that company. And so, being able to communicate those trade-offs and why you made those trade-offs, as you said, can be something that is powerful when approaching anybody that's looking to invest in your company, invest in your prototype. Thank you, Dr. Beck. All right, now we're going to go ahead into our closing question here. I'm going to go to Sahidi for this one. Now, Sahidi, to our Conrad competitors that are watching this from around the world, what is one lesson that you wish your team had known about finances or funding before submitting for the challenge?
Yes, of course. I think the single most important lesson that I learned through the process and wish I knew at the beginning and still have carried with me is that your financial model should be telling the story of your values, not just your revenue. And so what that means is it all ties back to the mission and why your product is important in the market it's being sold in and why you're building it. I think that's something that's super strong, not just in Conrad, but like in any venture you take on. So when we started, I think looking at our financial models, we were really focused on making sure numbers worked, making sure we were pricing it. So we were making some sort of margin, making sure that we'd like cost it at this and sell it at this and everything. But the only thing that really resonated with the judges and when we started to capitalize on was the fact that when we showed them our pricing strategy, it also embodied our mission. We were selling our most basic model at $12. It wasn't a profit driver. It was proof that we could make this technology with profit, but also scaled down. We weren't getting the hugest margin on that, but we were doing it in a way that a lot of people could now access it. We also were able to do something that had a little bit of a trade-off. We created two products, not just one. So there was two different models. One was for bigger institutions. One was for smaller local groups in the areas. And so that was another thing. We were making sure that our technology worked and was something we could, again, sell to the people who needed it. But we were also making sure it was something that was adaptable for different types of people, for different use cases and everything. So my advice, again, is to not let your financial section just be a spreadsheet of numbers, but honestly, just let it be an argument for why your innovation matters and how it's going to survive in the real world while also staying true to its original purpose.
Wow. Yeah, I absolutely love your financial story. The storytelling should share your values, not just your revenue and dollars and cents. I think that's something that's great. A great piece of advice for our competitors. Thank you, Sahidi. Now, to close out this section, Dr. Beck, you've worked across projects with very different levels of risk and scale at a global level. What's one financial lesson or mindset you think every young innovator or entrepreneur should take with them today?
I'll say two. I'll say one is the fundamentals, understanding how numbers tell a story, NPVs, IRRs, probabilities. But the other one, especially this is an Equinor sponsored event, and I have my Equinor hat on, it's safety. We looked at some coin flips it could be a 70% chance of $10 and a 30% chance of zero. But when things go wrong, they can go very, very wrong. And so we always need to be aware of risks, right? It's not just lose money. It could be injuries. It could be deaths, oil spills, ships taking out a bridge. We need to know what are the really big things that could go wrong? What are these risks and how do we mitigate them? If we're creating a product, what are the dangers involved in this product? What are the things that could go very, very wrong? And how do we make sure those things never go wrong? Because you're licensed to do anything, to invest, to operate, to be any kind of business person, is you have to do it safely and you have to make sure that everyone stays safe and that your product is doing what it should do and doesn't have those adverse effects. So that would be my number one thing. It's safety.
All right. Well, yeah. So fundamentals and risk. I think those are two great things that students, and especially that risk aspect, it shows not only the judges, but any potential investors or venture capitalists who are looking to take a risk on a company. If they know that this company is evaluating those risks, they're looking at every single area of what could go well and what could go wrong, which builds trust, which builds that relationship, which shows that transparency, ties a lot of the things that we've talked about today. And so with that being said, I want to thank you both. It's powerful to see how professional principles and alumni experiences align so naturally. From Dr. Beck to Sahidi, you've both shown that the financial thinking is really about confidence. It's about relationships. It's about trust, understanding your choices, your risks, and most importantly, understanding your value of what you're bringing to the table. And so we want to thank you both for those insights. And you've really given our students some great stepping stones to be successful in Conrad and beyond. And so now what I want to do is we're going to move on to the next section here. Let's open the floor for some audience questions. And we see we have a good crowd with us today. So we're going to open it up to the Q&A. Our producer Megan is moderating questions in the chat. And so if you have a question, it could be something that we've talked about today when it comes to finance and funding. It could be a Conrad Challenge question, or it could be a general question. Go ahead and you can click that Q&A section, and we will open the floor to anyone that has questions for us. All right, this question comes from Deba S. Sorry if I misspelled that, Deba. What evidence do judges find most credible when evaluating teams' probability of success and value if successful? I'm going to go ahead, Sahidi, because this one is a judge question here. I'm going to throw this one to you.
I think the best value add, honestly, is demonstrating proof of demand. So you need to show that people actually want what you're selling. you need to show that you've done your research in the customer market and that you're also looking ahead into partnerships and pilot programs and testing. Your first product, your first version of the product is not going to be perfect. It's not going to be perfect in the manufacturing costs. You're not going to be doing it the most optimal size or level either. But doing market research can really show that this is something that people will want as time goes on. And it's really easy to prove a lot of things once you explain that demand is real and the risks that you're presenting are either low or something that you are identifying and solving.
All right, we did get another question in here from Sunhoo Park. And I think this one is a great one for Dr. Beck. If we have a business that has a great future potential, but takes big manufacturing cost at first, like the first 1 or 2 years, how can you persuade investors, and I'll expand, invest for that future growth?
Yeah, when I think about a large scale investment, if I'm thinking, several $100 million to build a factory in, that's a huge risk. That's a lot of money. So I think there's two things I think of. One, you need to have sales lined up in advance or a plan to get sales lined up. You need anchor clients. So if I need to spend $400 million to build a factory, I want to have at least a couple $100 million of sales lined up so that I know I've got that going. I've established a market, and then it's about building that market. But you need an anchor client. I think the other thing is you start getting into commercial partnership situations where it's thinking about, hey, one investor isn't going to want to take on that whole risk. But if you have multiple investors, now that's a different situation. Now it's a coalition. Again, if you think of bundling lots of smaller deals together, that's what everybody wants to do. The other thing, if it's a big manufacturing situation, you open up different levels of funding, particularly if you have anchor clients. So again, if I've got $200 million of revenue lined up for a $400 million factory, I can also finance against that revenue and I can get bank money. So it's not just the person I'm working with over here. I can also get some external financing based off of that anchor client. So I'd say you start getting into more of a commercial space and you really want to have more of a detailed commercial plan. But also it comes back to the fundamentals. Again, Sahidi was talking about storytelling. Why is your product that exciting? Why should people want to put that money into it? Because you can also figure out details later.
Oh, thank you for sharing that, Sunhoo. I hope you were taking some good notes there. Those are some great knowledge right there. Well, we're getting close to time, so I want to go ahead and just start wrapping things up. I want to say thank you, everyone. A huge thank you again to Dr. Andrew Beck of Equinor, our Conrad Challenge premier sponsor, and Sahidi, our Alumni Leadership Council member. Thank you for sharing your knowledge and helping our students and supporting the next generation of entrepreneurs and innovators. Just a couple key takeaways from today. Remember, we're using research and we're using reasoning to be able to bring reality to our funding. We want to share our story, as Sahidi said. Your story should share your values more, just as much as it shares the dollars and cents. We want you to think through how your project could sustain itself through revenue or funding, taking in those risks into consideration, communicating the trade-offs and the iterations you met, keeping your scope realistic. Your budget should reflect what you can truly achieve. Sahidi discussed that beautifully today. So thank you for spending time with us today. And remember, the most successful innovations aren't just bold, they are built to last, right? Until next time, happy innovating, everybody.